The markets are currently closed for the Thanksgiving holiday, but the last traded price for Tilray Brands Inc., ticker symbol TLRY, on Wednesday, November 26, 2025, closed the session at exactly $1.03 per share, seeing a daily lift of roughly 4.76%. However, looking at that closing figure is like staring at a photograph of a house that just caught fire 5 minutes after the picture was taken. The real story, the one that is currently sending shockwaves through every online investment forum and causing sleepless nights for retail holders, happened immediately after the closing bell rang. In the after-hours session, Tilray shares plummeted, shedding over 16% of their value in a matter of minutes, dragging the price down into the 80-cent range. This volatility is not just a standard fluctuation, it is a violent reaction to a specific, fundamental corporate action that we need to dissect immediately. The expectation heading into this holiday week was that Tilray was positioning itself for a Santa Claus rally, riding the coattails of the broader market optimism we have seen in heavyweights like Nvidia stock or even Apple stock. Investors were lulled into a sense of tentative security, believing that the company's expansion into craft beer and the lingering hope of U.S. federal rescheduling would provide a floor for the stock price. The reality, however, has arrived with the subtlety of a sledgehammer. The company announced a 1-for-10 reverse stock split effective December 1, 2025. This is the moment where the narrative shifts from growth potential to structural survival, and it forces us to completely reevaluate why we are holding this asset. When a company executes a reverse split, specifically one of this magnitude, it is often because they are battling to maintain compliance with exchange listing requirements, or attempting to artificially inflate the share price to make the stock appear more attractive to institutional capital, the kind of money managed by Fidelity Wealth Management or accessible through exclusive Fidelity brokerage accounts that often have mandates preventing them from buying stocks trading under $5. Let's be real about what this means for you as an individual investor. If you were sitting there looking at your portfolio on your Robinhood app or checking your balance on SoFi Invest, the optical illusion of a higher share price next week does not change the fundamental value of the company. It essentially just slices the pie into fewer, thicker pieces. The fear here, and the reason we are seeing this massive sell-off in the after-hours, is the psychological stigma attached to reverse splits. Historically, in the cannabis sector, look at Aurora or Canopy growth, reverse splits have often been a precursor to further downside. It signals to the market that management does not believe the stock can organically trade its way out of the penny stock basement in the near term. This is the tension between the expectation of a turnaround story and the reality of financial engineering being used to reset the chessboard. We have to look at the volume behind this move. In the regular session, volume was healthy, hovering around 39 million shares, which is consistent with the liquidity we usually see on Interactive Brokers' trading platform for this ticker. But the selling pressure post-announcement indicates a capitulation from retail traders who have been holding on for years, hoping for a return to the glory days. These are investors who might use Schwab Intelligent portfolios or similar robo-advisors that might automatically rebalance or flag this kind of volatility as a risk factor. The sheer velocity of the drop suggests that the patience trade has officially expired for a significant portion of the shareholder base. They aren't waiting for the federal government anymore, they are looking at the math and heading for the exit. However, to simply write Tilray off as a failed pot stock is to ignore the actual business model that Irwin Simon has been building for the last few years. This is where we need to separate the stock price mechanics from the company's operations. While the cannabis sector remains a regulatory minefield, Tilray has effectively transformed itself into a consumer packaged goods giant with a massive alcohol portfolio. They are now the 4th or 5th largest craft brewer in the United States. Think about that. They own Sweetwater, Montauk, Breckenridge, and a host of other brands. This isn't just a side hustle, this is a deliberate hedge against the slow pace of cannabis legalization. When you look at the cash flow, the beer business is what is keeping the lights on. It provides a steady, predictable revenue stream that purely cannabis-focused competitors simply do not have. This creates a fascinating divergence for those interested in self-investing. Are you buying a struggling cannabis operator, or are you buying a distressed alcohol distributor with a free call option on global weed legalization? The strategic pivot to alcohol was arguably one of the smartest moves in the sector, yet the market refuses to value Tilray as a brewer. It continues to trade in lockstep with the broader cannabis ETFs. This correlation is the enemy right now. You could have the best quarter in beer sales, but if the DEA decides to delay a hearing or a particular bill gets stalled in the Senate, Tilray stock drops. It's frustrating, but it is the reality of the algorithmic trading environment we live in. Investment sites and automated trading desks group these stocks together, and breaking that correlation is nearly impossible without a massive shift in profitability. Let's discuss the political landscape, because you can't talk about Tilray without talking about Washington. We have been hearing about the Trump effect and the potential for rescheduling marijuana from Schedule 1 to Schedule 3 for what feels like an eternity. The narrative expectation is that rescheduling is the silver bullet that fixes everything. It removes the 280E tax burden, improves cash flow, and legitimizes the industry. The reality? Even if rescheduling happens tomorrow, it does not solve the issue of capital saturation and lack of pricing power in the Canadian market where Tilray is dominant. It helps the U.S. operators more than it helps Tilray, at least initially. Tilray is betting on federal legalization, or at least permissive access that allows them to export or acquire U.S. assets directly. Until the Berlin Wall of federal prohibition comes down, Tilray is essentially a king in a castle surrounded by a moat they cannot cross. We also need to consider the international angle, specifically Germany. The German legalization framework, or KANG, has been a bright spot. Tilray has a significant footprint there, and as the European market opens up, they are arguably better positioned than any other Canadian LP to capitalize on it. This is the sleeping giant part of the thesis. If you are using Fidelity International Trading or similar global investment help tools, you know that the European medical market is higher margin and less saturated than Canada. The growth numbers coming out of their international segment have been robust, up over 100% year-over-year in some metrics. This is the disconnect. The U.S. stock price reflects U.S. political dysfunction, while the actual growth engine is humming along in Europe and the alcohol aisle. Now let's zoom in on the technicals because the chart is looking incredibly damaged after this reverse split news. We were seeing support establish around the 0.87 to 0.92 level, a zone where value buyers on Robinhood trading apps were stepping in. That support is now effectively resistance. When the stock begins trading on a split-adjusted basis on December 2nd, we are going to see a new psychological battleground. If the stock splits 1 for 10, a $0.80 becomes $8. The danger with reverse splits is that short sellers love them. They see an $8 stock with negative momentum and they short it back down to $5. This is the death spiral scenario that long-term bulls are terrified of. We need to see the stock hold that post-split level firmly. If it starts drifting lower immediately after the split, it indicates that the market has zero confidence in the management's ability to execute. Speaking of management, this is a time to scrutinize the C-suite. Executive compensation has been a hot-button issue for Tilray shareholders for years. When the stock is down 90% from its highs, seeing massive bonuses paid out feels like a slap in the face to the average retail investor, using their hard-earned money from their Fidelity IRAs to back the company. The reverse split is often viewed as a management failure, an admission that they could not create enough value to keep the stock above $1 organically. This sentiment is palpable on social media and investment forums. The trust battery is low, and the only way to recharge it is through consecutive quarters of positive free cash flow, not just adjusted EBITDA profitability, which many savvy investors view as a meaningless metric filled with add-backs and exclusions. I want to pause here and ask you guys a question because I really want to gauge the sentiment of the room right now. Comment below how many shares of Tilray you currently hold, and more importantly, are you planning to hold through the reverse split, or are you selling on the next bounce? I want to see if the retail army is retreating or digging in. Let's shift gears to the institutional side. Who is owning this stock? We see presence from major passive index funds, likely held in Fidelity mutual funds or Vanguard accounts, simply because Tilray is a constituent of the cannabis indices. But we aren't seeing massive accumulation by active managers. That is the tell. The smart money is waiting. They're waiting for the regulatory smoke to clear. They don't gamble on binary political outcomes. They invest in cash flow. Until Tilray can prove that its beer business can subsidize the cannabis operations to the point of net profitability, the institutional floodgates